and not too crazy in the lead up to Christmas. Firstly, just well done on making the time to make this happen. I was just chatting to Kate about how crazy the schedules can be at this time of year, and making time to make this happen, flex the muscle for the new year. So today I'm going to be talking all about how to buy a property the smart way in 2021. Helping you understand some of the key, I suppose, areas, property basics. We'll talk about some property strategies, and then beyond that, we'll talk about some of the key things to be aware of, so that if property is one of the goals that's on for your New Year's resolutions, that you understand the things that you need to know to figure out what you should be doing to get started. So I've got a bunch of stuff to go through, and then I'm going to have a lot of time for Q&A. Last time we had a heap of really good questions. So feel free to pop them in as we're going through. Pop them in the chat. Pop them in the Q&A section. Sorry, and then we will see. I'll do my best to get to as many as I possibly can. As we go in. Can I just for the guys watching on, I just can't seem to see my slides. Can everybody see my slides okay? Can we just confirm? Can someone just pop into the chat? Perfect. Okay. Happy days. So look, guys, please, just before I jump into the content, please don't rush out and make any life-changing decisions off the back of the presentation today. I strongly encourage you to seek out some quality personalized advice before you jump in. Property is a huge decision, and we'll talk about some of the numbers there. But the opportunity of getting this decision right is something that is going to make you, hundreds of thousands of dollars over your lifetime, save you a lot of pain along the way. So you should be thinking about doing that anyway. We'll talk a little bit more about that as we go through the content. So guys, before I jump into the property super specific stuff, that I just wanted to go through some, I suppose, common challenges that people face when it comes to their money. And I know that everybody's, their own unique, delicate snowflake, and but there are some really common challenges when it comes to money. And these are the three ones that I see, and property is no exception. That there is so much information out there that it's like we're drinking from the fire hose. Everyone's got an opinion, especially property, especially parents' generations and that sort of stuff. They've all made money from property. They reckon that they're an expert. Buy a property here, follow the hot spots, go to the golden triangle, do an investment property, buy and flip, buy and reno. It's like you're just drinking from the fire hose, and there's so many options that it becomes really difficult to know who to listen to, who to trust, and you end up just paralyzed. The second thing, and ties in really with property as well, is the balance, finding the right balance between the personal things that you want, the lifestyle things, having a really nice place, having a short commute, having a bit more space, having cupboard in the hall, like those, balancing those things with the financial impact of doing that, and finding that balance. And the third one, and this is double-edged, so there's FOMO, and the hindsight thing, which people tend to kick themselves. But then there's FOFU, which is probably even more relevant, which is the fear of fucking it up, basically. So that fear of doing the dumb thing, that where you blow up a bunch of cash and you have to go back to the starting line. What it does is it leads people to get what I call stuck, which is not always stuck doing nothing, but it's stuck doing the same thing that you've been doing in the past, and then missing those opportunities to be getting better results. So there are three elements that you need to get right to move from that position of stuck to success for your money broadly, but just as importantly for property. So the three elements are having a good structure in place, which is understanding what money's coming in, what money's going out, and where's it going. You want to make it easy to save and manage your money, but hyper focused for property is you need to make it crystal clear what you've got to work with, which you can then use to direct a property or your mortgage payments or your lifestyle once you have ultimately bought that property. The second element is that you need to have a really good strategy in place. So you need to understand what is the outcome that you're working towards, what are the options or the scenarios, the approaches that you could take. And I find that when it comes to property, specifically around strategy, that people, and I'm sure this is on another slide somewhere, but people, how it feels, property feels, having your own house, and you can paint the feature wall, that special shade of the pastel orange that you saw in that Instagram feed. And that feels good. But if you make the decisions based only on that and ignore the numbers, then you can make decisions that you will later regret. When it comes to having an awesome strategy for your property strategy, it's about really exploring, do you buy as your own home? Do you buy as an investment instead? Let's explore what that is, because the numbers are different. So it could mean that different implications for your lifestyle, different implications for your asset growth over time, different implications for the sorts of property that you buy and how you tackle things. So really important. And then the third is having good investment solutions in place. And that means good property assets in place, solid properties, and that are going to make you good money over time. And I'll give you a bit of insight as to how you can start to tackle choosing or finding out what that actually is for you. So firstly, I'm just going to jump into some of the basics around property. But firstly, and I know that everyone, including myself, is sick to death of hearing about property, but it'd be silly of me to not talk about something around COVID with property. But what I've found is that this new normal is slightly unclear, but I believe firmly that the property market has been permanently disrupted. We're seeing an enormous exodus of people out of the cities into Byron is kicking up, and because people are rethinking and saying, why, from Sydney in particular, which is where I'm based, that the property, to get a 3-bedroom house, in any sort of close proximity to the city, you're looking at close to a couple of $1 million. And I think people are saying, well, if I can get so much more further away, and given that a lot of companies are allowing people to work from anywhere, I know that almost all of the big tech companies are basically giving people first right at working from home if that's what they want. And I think that's a permanent level of disruption. There's also a lot of government life support floating around for businesses and individuals and people, which is going to supporting different investment markets. The share market is almost back to all-time highs, and the property market to a degree, ultra low interest rates, and these things are supporting things now, but it is going to change. So being aware of what the potential impacts are so that you can really make sure that you're making the right moves when it comes to your property investments is going to be valuable. So, the thing is on COVID, that for people, financial freedom is still important. Smart companies are still making bank. Bondi is still a thing. People are going to want to live there. And I just use Bondi because I'm from Sydney, but Bondi, Mossman, Surrey Hills, Richmond, the place in Victoria, Red Hill or something in Brisbane, those nice places, good lifestyle, they're still going to be appealing. And really, it's when you look at back at history and periods of volatility and ups and downs in markets, share markets, property markets, it's these downturns like the ones that we're facing right now that actually make people a bunch of money. So be aware that when you're the fear is really easy. It's easy to fall into that fear trap and end up holding yourself back. But be prepared when opportunity sits and you've got a good strategy and risk management and all of these things in place. Take advantage of that opportunity and make some money. So in my view, the new normal is going to be pretty normal with some exceptions, which we'll talk about. So the power of property, I just wanted to I suppose, kick things off by talking through like why we do this and why property is so powerful. And what I've got, and please forgive me that there are a lot of numbers on this screen. I recognize that. But what I'm trying to show is that invest in a property worth $500,000. I've got a growth rate on this property of 5%, which is well below the Australian long-term average growth rate for property, which is 6.8%. In fact, if you go back or I think I went back 6 decades, but that number has held true for every 10-year period over that, and every property prices have more than doubled in every single 10-year period over the time that we can see. The end value. So in this case, if you buy a property in year 1, it grows at 5%, and this is not, properties don't grow on a straight line, but over the long term, you can average out that growth. And it's my personal view. We know that the past doesn't predict the future, and disclaimer. But it's my personal view that will happen for the right properties in good areas over the next 10 years, and the 10 years after that, and the 10 years after that. So if the property grows at that rate, then with the end value in a year's time is $525,000. The total growth that you've received on that property is $25,000 over that period. Then I've got years 2 to 10. So it starts at $525,000. I'm trying to get into decades here, which I'll get to in a sec. But over the following 9 years, we get growth of $289,000. The end value is about $814,000. Now, total growth in 10 years, you've made $300,000, which is it's a lot of work to save $300,000 or to grow $300,000 through share investments and stuff. Then you see that for the next 20, 30, and each of the next decades, that we start to get this compounding impact. So in the first decade, the total growth was $314,000, but in the second decade, it's $826,000, almost 3 times as much. Then in the 30 years, it's $1.6 million, double from the whole previous 20 years. So you basically got 20 years worth of growth in 10 years. And then in years 40, it's $3 million of total growth at that time. And your $500,000, your little cozy $500,000 property is worth $3.1 million. Now, be aware that, in 40 years time, a cup of coffee is probably going to cost like $40 or something. So there is a bit of inflation element that's in there to be aware of, but you can see that it is super powerful, and the growth really does accelerate over time. But because with property, we always start from a reasonably large starting point, that you then get the compounding just happens much more quickly. So when I contrast that, and I just for comparison purposes, that I wanted to put in how it compares to share investments that are growing at the same growth rate. And look, 5% is actually well below the long-term growth rate on shares, should be like 8.7%. So again, I'm being pretty pessimistic here, but you see that it's $105,000 after 1 year, $110,000 over the decade. The 20 years is $265,000. The 30 years is $446,000, and there's $777,000, which is a lot of money, right? And this is why shares are great. And I think for most people, there should be some sort of combination of the two. But you see that the property investment is worth significantly, you get a significantly higher level of growth because we're starting from such a big starting point. And that's really the power of property, is the power that when you buy, if you got $100,000 and you want to go buy $100,000 worth of shares, then you end up with $100,000 worth of shares. Whereas if you have $100,000 and want to go buy property, you can buy a $500,000 property. Then you've got this $500,000 asset that's working for you. So again, both of these are great, and shares can be a really great stepping stone to get into the property market, because saving a property deposit in cash is going to be super duper hard. So we need to do something to build that momentum. So it's totally an option, but you see that when we can introduce property into your overall sort of financial strategy, that it does have a really powerful impact on how quickly you get ahead. And that's why it's so important to consider. But the problem is, and what holds a lot of people back when it comes to property and getting started, or starting their strategy to ultimately get into property, is that we don't always know where the risks are coming from. And what I've got here is that you can only manage the risk that you understand. so when you're making your money moves, and especially when you're making big ones like property, or really getting started on this like on a savings and investment plan to get into property, you need to understand where are all the risks coming from, and then for the risks, how can I manage those risks? And then beyond that, there'll always be some level of risk left over. So risk is what makes you money. Buying in shares is risky. Buying property is risky. Doing nothing is risky as well. So it's about understanding the risk and how you can manage it to then establish for you. And it's different for every one of the hundreds of people that are on this call, that it's different for every person what acceptable risk is and what unacceptable risk is. But if you don't know and you don't understand, then you're not going to know, and you're either going to get paralyzed by that inaction trap, or you are going to take the leap, and it's going to be a super scary ride. So just again, some of the basics of property. Leverage is that key driver. That's what I was talking about before. Really, the power of leveraging just means borrowing to invest, or gearing is another term for that. That leverage is the key driver of the power of property returns over time. Now, if we compare like the ASX to this long-term investment report, and if you look with an investment property versus a diversified investment portfolio, property does sort of win, because the long-term net return on property is, well, long-term gross return on property is essentially 9.8%, whereas for shares it's about 8.8%. So it is slightly ahead. But it's really that 1% is the driver of what makes the huge difference between the outcomes is the power of leverage and borrowing to invest, as I mentioned before. But you need to be aware with property that entry and exit costs are really high. I was just having a conversation with a new client yesterday, and they were talking about, oh, maybe I'm just going to buy this property for a little bit, and then maybe I'll sell it in a couple of years' time. And when we went into the numbers, that outside of government benefits and the additional support that you can get, that there are the rough rule of thumb for purchasing a property is that you're going to be spending about 5% of the property value in costs. So if you've got a $500,000 property, the rough cost to you to purchase that property is going to be somewhere around the $25,000. If it's $1 million property that you want to buy, it's about $50,000. If it's a $2 million property, it's about $100,000. And the big driver of that is stamp duty is the main one. I know that in New South Wales, it's about 4% of the property value. They're thankfully talking about getting rid of the stamp duty, but I've had a bit of a look at that proposal. And if you're buying property for a long-term investment, it seems likely that stamp duty is still the most favorable option, because what they're talking about is having a permanent land tax that you pay every year over time. Now, if you're buying and selling properties, then paying land tax could be okay, because you're only holding the property for a shorter period of time potentially. Whereas when you're buying for long-term wealth and asset building, then because you're going to be holding a property for a longer time, it's probably more money saved for you. But those entry and exit entry costs are high. Then to get out of the property, you have to pay for the real estate agent and the fees that are associated with that, generally 2% of the property value. So you pretty much, to buy and then sell a property, you're looking at about 7% of the value, which on a $500,000 property is $35,000, on $1 million property $70,000. That's a lot of money, and that's something that can then eat into your return. So be aware that of that and the impact on if you're thinking, because there's a lot of these spruikers out there that talk about these U-Butte strategies where you buy, sell, flip, buy, sell, and flip and make money. But I'm sure the state premiers would all appreciate the donation to their coffers, but it doesn't tend to make a lot of sense for the user after all of the costs. Looking at investment versus owner-occupier, I touched on this before, but there is a pretty significant difference on the financial impact of your ability to buy a property one way versus the other. It depends on what there's no one, it's not that investment is always cheaper or that owner-occupier is always cheaper. It really depends on your salary range and your tax rate. How much you're borrowing and how much you're spending, what the interest rates are at the time, or what we anticipate the interest rates to be over time. And so you need to really crunch the numbers specifically for you. But investing can be a good way to get into the property market sooner. If you look at buying property as your own home, then sometimes when you look at the mortgage payments, the ongoing property costs, which a lot of people forget about, strata, maintenance, insurance, all of these sorts of things, then when you look at an investment property where you just need to fund the difference between the rent and the costs and stuff, then it can be different as well. That can allow you to get in sooner. So it is worth taking the time to crunch the numbers and be strategic about what's going to actually be best for you. Looking at where to buy is a really, really big decision as well. And it's something that, again, a lot of people have opinions on this stuff. I can only give my opinion, but my view and what we've seen, and it's based on what we've seen in sort of the last forever, is that there are the most, I'm going to say the word blue chip. When you think about blue chip investment companies, and we compare this to an investment in a share portfolio versus an investment into one or more properties. Now, when you buy shares, you can buy small little volatile shares, and sometimes if you get it lucky, if you get it right, or if you get lucky, then they'll shoot the lights out and you make a whole bunch of cash. But generally, the most effective strategy over time, certainly what we've seen, and you can look up the stats, but that buying big, solid, stable, profitable, good businesses, and then expecting the average sort of return it's a very sensible strategy. It's a lower risk strategy because you're not stressing out with these massive swings and roundabouts, and you generally enormously reduce your risk of blowing up and getting a really terrible outcome from your investments. That's why if you look at companies like index funds or like Raiz Invest, who they're sponsoring these guys, you look at the portfolios and they're stable, long-term investments. When you look at property, in my view, it's the same. So I've rattled off a bunch of suburbs before, and I just know, because I know Sydney really well. To me, it doesn't matter if you buy a Mossman, the Lower North Shore, Surrey Hills, Bondi, the very close inner west. All of those suburbs are going to be, they've got very limited land supply, very limited property supply, and they've got a huge amount of population growth or demand that's anticipated over the next several decades into the future. Now, people in the past have been lucky by buying in areas like these hotspot areas that are scattered around the country, but they're generally undervalued areas that then, because of some change or something that happens, that the values go up significantly. But it's not sustainable to do that, and you may get lucky or you may fail. And having a property, and I've been in this position. I bought a property in uni up in southeast Queensland, and it was just a dog. Like, it just never made me any money. It didn't really cost me much money. Made a few $1,000s on it when I sold it, but right, it was for 7 years that I had this property, which is just a pain in my neck, and dealing with tenants and dealing with agents and all of these things. It just not worth it. So that, plus also when you're trying to get ahead with buying property, buying one property reduces your borrowing power to buy other properties. So if you have a bunch of, even one or more underperforming properties, then it means that you can't go and buy better properties to actually make you money. So my view, look at limited supply, desirable blue chip suburbs, basically not inside a CBD, because CBDs are a bit risky with all the high-rise buildings and stuff, but anything out of Sydney, Melbourne, Brisbane, CBD. Perth scares me a bit, although I'm sure that there are good investments over there. Adelaide, same deal, because it's just all basically pensioners and people that want to escape from Adelaide, which constrains the demand for properties. Although I'm just joking a little bit there. There may be some good areas there. I just don't know them well enough to know. But I would say Eastern Seaboard, they've got the strongest projected population growth in Australia over the next 40 years. You can look up all this stuff online with the ABS, the Australian Bureau of Statistics. data. Careful for the engineers on the call. Don't go too crazy here. That's one of the risks that I'll talk about in a minute. But knowing that you've got the strong fundamentals is going to be a much less stressful ride, and in my view, again, probably perform best in the over the next forever. Then the other thing to be aware of is around the balance between your home versus non-home assets, and this is something that I see a lot with, especially with my tech guys, that they are people that have made a bunch of money through maybe employer share plans or inheritances even is another thing that people, when you start to think about the possibilities, and everyone wants to live in a really awesome home. Like there's not a lot of people that don't want that. But when you look at the numbers on buying, a multi-million-dollar dream home, and then look at the costs of paying that down, the mortgage that's associated with it, the ongoing costs that are there, and then what that means for the amount of money that you have left over to actually build your assets and investment assets outside of your home, then you need to, getting that balance right is critical, because, and I've seen a lot of people get it wrong, that you end up with this amazing roof over your head, which is great, but it's not something that makes you money. In fact, it's something that costs you money. So you want to just make sure that you're keeping an eye on where is your real actual financial wealth versus where's a nice roof over your head. Also, yeah, definitely stepping stones into your dream home, buying property, buying an investment property, buying a smaller property, and then building a diversified share portfolio to build up your deposit faster as well. These are all things that you can use as stepping stones into your dream home. So don't just think that you're going to have to save an enormous pile of cash to buy a great property or to buy the dream home that you want. Because the downside of doing that is it's pretty slow going, demotivating. It's not very fun. It's not very exciting. And it seems, because it's such a big goal and it seems so far away, it's easy to deprioritize it in the moment or in instances over time, and end up it takes you so much longer to get to where you want to be. So just want to run through some of the strategies that you can use around property. The first one I've got here is the family guarantee. Family guarantee, family pledge, they call it a few different things. Guarantor setup, I'm sure there's some other names for it as well. Basically, it means that where you, instead of having, because you need a deposit to buy a property for the banks to lend. So you do want to buy a property, but you need this deposit. So it means that that deposit is guaranteed against equity in a family's property. So if you've got, your folks, and it doesn't need to be family, but it's just generally, Joe Blow off the street is unlikely to let you borrow against their home. But if they've got the value of the property is significantly higher than the mortgage on the property, then there can be what's called available equity. And you can use that equity as a deposit for your home, means that you avoid lender's mortgage insurance. You could even cover the costs, that 5% entry cost of the property. And basically, you still need to be able to what's called servicing the loan, which means you need to fund the loan repayments. The banks will still assess that. But if you tick the box to have the deposit covered, then you can basically buy property almost immediately. And this is something where I see people are in a really strong position from a cash flow perspective. Like if you've got strong surplus savings every week or month or whatever, then the barrier is the deposit to get into the property. If you are, and this is not something that's right for everybody, but if you are in a position where your folks are in that and they're not too crazy, or they would allow you to potentially do this, wouldn't hold it over your head for the next decade until you got out of it, and then you might think about using something like this, and it can allow you to buy property straight away. Negative gearing is something else to be aware of. Now, this works only with investment property, so it doesn't work with your own home. But gearing just means borrowing to invest. So you can have negative gearing, as I've got here, or you can have positive gearing, or you can have neutral gearing. They're the three options. And the gearing means borrowing to invest. The negative, positive, or neutral, that relates to the the cash flow of the purchase. So if the total expenses and mortgage repayments are more than the rental income that you would receive on an investment property, then the cash flow of that property is going to be negative. And if you borrow to invest, then that's the definition of negative gearing. If the rental income, the mortgage payments and all of the expenses of the property are less than the rental income, then the cash flow is positive and you've got a positively geared property. If it's neutral, then it's neutrally geared. You get the point. So, but with negative gearing, you actually claim a tax deduction for the negative amount. That you claim a tax deduction for the shortfall, which means that if you've got an income above like 37,000, then you're going to get a third of whatever you're paying back in your tax return. If you're killing it and in the top marginal tax bracket above 180 grand, you get half of every dollar that a property costs you back. So the rough rule of thumb with investment properties, and at the moment it's actually a bit less than this because the interest rates are just so insanely low, but an investment property should cost you about 2% of the property value. How we get to that number is that the net rental income should be about 3%, and then the interest costs, ongoing property costs, and the mortgage repayment should be about 5%. So the difference between them is 2. So $1 million investment property should be costing you, from a cash flow perspective, about $20,000 a year. Now, half of that $20,000 is going to be what's called a principal repayment to actually pay your mortgage down, if you're assuming that you're using a principal and interest mortgage loan. But the other 1% is pure expense to you, and that's the part that's actually deductible under negative gearing. Now, you can get somewhere between a third and half of that back. So you see that the after-tax cost of having an investment property comes down to about 1.5% of the property value, which can mean, and that's what I mentioned before when I meant it's like it can be more easily achievable than saying I want to go buy this $1 million property, then I'm going to fund all the mortgage payments and all the costs and all of the things that go around that. Deductions, yeah, that's just what I was just talking about. One other thing for people that already have property or that are looking to buy property is that you should be really, really careful in the difference between using an offset account and a redraw account, because the tax treatment is entirely different. An offset account does not pay down your loan, whereas paying money into the loan and then having money in a redraw and potentially taking it out, that is actually paying down your loan. And when you redraw from a mortgage, it's actually considered a new loan. So if you pay down the loan, say on either an investment property or on a property that ultimately becomes an investment property, if you redraw those funds, say to buy your dream home, then you don't get the tax deductions on the interest payment. So it can be a massive, like tens of thousands of dollars a year difference in the financial outcomes as a result of that strategy. So offset versus redraw, be aware of that. Debt recycling is another strategy that can be really great and allow you to create a bunch of tax deductions whilst you're actually investing into a share portfolio and paying down your mortgage at the same time. So how it works is that you basically pay down your mortgage loan. If you say, and this, sorry, I should just qualify this by saying debt recycling strategies only work for people that are in their own homes already, in a home that has non-tax deductible debt, because there's no tax deduction for the interest payments on your home loan, unfortunately. So the debt recycling strategy works by paying down the mortgage at the same time, drawing the money back out and putting it into an investment portfolio, because you're essentially borrowing the money to invest into the investment portfolio. Then it means that the interest payments on that portion of the debt become deductible. It does get quite complex, but essentially what it means is that it's a reasonably low risk strategy if you're already looking to invest, because all you're doing is you pay down your mortgage by $10,000, then you borrow $10,000 for this investment loan. Your mortgage amount is unchanged. So it's not like when people hear about this, they go, shit, I'm going to be borrowing all this money to invest. That's crazy risky. Not the case. So it can be been doing a few significant like debt recycling, people that have got a bunch of money from from a tech company boom or selling out or something like that. And it's literally tens of thousands of dollars that they save each year. So worth looking at. Just in terms of how you can buy a property as well, that there are a few different ways. You can buy property direct. You buy it on your own, borrow, go to the bank, whatever. That includes doing a family guarantee type setup. Another thing that you can do is you can buy with family or mates. This is a question that I get asked sometimes, and for me, I am dead set against this. I think it's property is such a big asset, and things, what we want and what we want to do, and our situation, and all of these things change over time, such that if you buy with a sibling or like your cousin or some mates, that it's like in the future that they might have different ideas to you, different objectives. You might end up having it, falling out, and then it's a huge problem. It's just not worth it, in my view. Now, I know I have seen people do it. I've got some clients that have done it, and it's all been okay. But for me, I just think property is your own thing. The other part about buying with other people is that you are responsible for their mortgage in the bank size as well. So it means that you can only really buy half as much property over time. So that's, to me, a major disadvantage. You can use, someone was asking me actually just online about like apps like BrickX and these fractional investing apps for property. For me, I think that I'm not a huge fan of those. I think that there are some really interesting options out there, and it is possible. But for mine, again, it's just there's a liquidity risk. We don't know what's happened. Like there's management costs and all of these things. For me, I would just think let's be strategic and find a way that you can get into property without having to run the risk of having something like that go wrong. The other type of property that you can buy is commercial property, and that can be a bit of a minefield as well. Although if you've got a lot of money, then it can be a really good way to create a solid income stream. Seek advice on that one. Property myths and mistakes, just before I jump into some Q&A. So one of the big ones, and potentially the biggest one, is trying to shoot the lights out with every investment that you make, whether that's property or anything else, that get so caught up in all of these stories of the people that have made a heap of money, and then you end up pushing it and you're trying to crush it. Now, it's very difficult to escape our psychology when we invest, but our psychology pushes us to make some really, really bad decisions. So you want to just be smart, be consistent, and be prepared that you're not going to hit the best performing property suburb unless you get really lucky. But you just want to have something that's going to make you solid money over time, which you've seen the power of that from some of the examples that I've gone through here, that you don't need to do this to make great money. Another myth is that you need lots of money to buy property. There are a bunch of ways that you can get there. The family guarantee is one of them. Building money through an equities portfolio to build some momentum sooner, buying cheaper properties if that's what's needed. Be careful, make sure that it ticks those other boxes that we spoke about before, though. But you don't need lots of money to get into property. Lifestyle risk is a risk that's not as commonly, like people aren't as aware of it as they should be. And it's the risk that when you purchase a property, that you end up in a situation where your lifestyle is the things that you want to do from a lifestyle perspective are inconsistent with your obligations in relation to the property purchase. And specifically where I've seen a bunch of people go wrong with this is that when buying property and then thinking about like starting a family, having kids, time out of the workforce, starting a business, these sorts of things that can be a drain on your cash flow, that it means that you can end up in this situation where you just don't have the funds available to do the things that you want to do. Making decisions in isolation, again, is another one for property. Any people go like, is this property a good investment? Now, any property can be a good or bad investment, but you looking at that choice in isolation without the context of your entire strategy is where you can run into some serious trouble. The lifestyle risk is one thing. Also, just being inconsistent with the investment objectives and the personal or financial objectives that you have over time as well. So you want to make sure that you're considering property as part of your bigger picture. Seeking the best option, that's, I suppose, trying to shoot the lights out. Maybe I'll duplicate it there. Unconsciously prioritizing. This is something for people that are saving to get into property. And I find that it's really easy because we're basically pleasure-seeking human beings and our psychology works against us, that we want the thing in the moment. That short-term dopamine hit in the moment is that the pull for that is real. Whereas when you're saving $100,000 or building a $100,000 deposit to buy a property, then it's a much longer play that people end up deprioritizing in the moment. So when you're setting up your strategy, what you want to be doing is to raise yourself up sort of 50,000 foot level and ensure that you're setting your strategy here, but then that you've got the frameworks in place so that you're the way that you manage your money is consistent with the priorities that you've set at that 50,000 foot level. That way, it makes it easier to avoid the psychology in the moment and actually get the things that are really important to you. And the last one here, I think it's the last one, is the wrong advice. And this is, property is a huge, huge minefield. I've seen a heap of people that have run into a bunch of problems with property, these dodgy property spruikers that getting these huge commissions and kickbacks from developers or their crony mates, or they've got they're doing, you know, the management services themselves. And it's just I see the temptation because there's so much money to be extracted, but it's going to lead to really substandard outcomes. So if you're talking to any property people, make sure before you get too far down the path, understand what are the sources that they get paid. They should be required to have like a financial services guide, which outlines all of that stuff so that you can double check, and then just keep asking questions and questions and questions and questions and a few more questions on top of that until you reach the point that you're comfortable that this person doesn't have some huge conflict of interest that is going to mean that you can get substandard outcomes and end up losing a bunch of cash. Going it alone is another one as well. I think when when it comes to property and property investing, that it's really easy to fall victim to our psychology, which we've spoken about a few of those things today, not taking advantage of opportunities and less confidence to actually pull the trigger and be aggressive when it's needed and when it makes sense. I see this with a lot of our clients. That I have some clients that at varying degrees lean into the advice and support that we provide. And, I think what commonly happens is that you see people that are in the same position before, and we talk about the same sorts of ideas, whether it's buying property or can be buying shares as well, is another thing where it happens. And people go, oh no, I want to do it, or I want to manage it, or no, everyone in the media says that this thing is going to happen and it's going to collapse and it's too scary, and you just fall victim to your own psychology, and then you don't take the action that you need to take to get the results you want. So when it comes to property, you see some of the numbers there, that it's a huge decision, and one that is going to make you, like I said at the start, like hundreds of thousands of dollars when you get it right. So don't be afraid to have some good people in your corner, pay a few bucks to get some advice. Obviously, I'm totally biased because this is the sort of stuff that we do, but you see that the multiples on the return on that investment over time are just going to be so big. And beyond that, you're just going to know that you're doing the right thing. It's like even with a great property buyer's agent, that they give you heaps of confidence that you got the right negotiating strategy, the right price point, the right approach, a good property. And like, what's that really worth? When you're doing these things, and property can be quite stressful. So anyway, that's my soapbox moment for the day, but can be difficult. Advice with agenda I've spoken about already. Although just be aware with probably financial advice outside of the property specific advice itself, that I've seen a bunch of people that have gone to financial advice businesses that have they're financially motivated to have these people not buy property and invest instead. And I think for me, if property is the important thing for you, that you want to have it, like having a fixed fee only business supporting you means that you pay them a dollar-based fee, and then they help you explore your options and choose the best thing for you. It's not like you go to some stockbroker, they're going to tell you to buy shares, or you go to some property guru and they're going to tell you to just buy property. if you use someone that can look and help you explore both, then it's going to mean that you're going to have more confidence in the decision that you ultimately make. So for me, I think that's a big way around there, and no conflicts around other financial products as well. So next steps from here. How to plan. So I just want to talk about how to put together a property plan, and then I'm going to jump into some Q&A. The first thing you want to do is focus on what's really important to you. What are the key things? What are the negotiables? What are the non-negotiables? Then understand all of the elements of your financial strategy and financial world that are going to impact your ability to buy a property. What money's coming in? What money's going out? Where's it going? Let's stress test that. Is it robust? Do we have enough in the holiday fund? Are we going to be happy to follow this strategy for the next 12 months or 24 months, whatever? Then what money have we got to work with? Shares? Are there some cash available? What are those things? And then think about what are the different scenarios that you've thought about that you want to explore. So, buying property as an investment, buying property as your own home. What are the price points? Buying property here, there, or wherever else. Then you want to understand what the numbers look like here. Understand the numbers, and then build some focused knowledge around what's not in the numbers. So understand, where are those risks coming from? How are we going to manage them? What risk is left over? What's acceptable? How do I feel about it? Does it make sense? And then from there, you're going to choose. You're going to be more drawn to one path than another, one that gives you balance between, the peace of mind, the confidence, the personal lifestyle stuff, and the financial outcomes. Then just need a bullet point into what is the action plan? What are the 27 steps that need to happen to turn the great plan into the great strategy into great outcomes? And then automate as much as you can if we're automating saving strategies or investments or whatever else. And 6 is about ongoing execution and just nailing that stuff down, and also just iterating your plan as what's happening in the world, in your financial world, and in markets around the world, and then what you want and how you feel about stuff, making sure that you're iterating as you go. The impact from a COVID perspective, I think in planning, and I'm a big advocate of this, obviously, as a planner, but having a good plan in place, even if you don't end up taking immediate action as a result of the plan, at least you'll know that you have the perfect plan for you. Don't let fear hold you back. The weapon that you have to combat your fear is knowledge, and the knowledge will empower you to bust through that fear and know that you've got the confidence there to do that. Defense is critical when it comes to COVID stuff as well. Making sure you've got a good emergency fund in place, that you're protected and that you're not overexposed. Very, very important. And the more complex or the bigger the numbers are, the more help you should think about getting. I'm going to leave you with this model. Talks about this is my motivation talk for today, and it talks about your progression from today to some point in the future, and essentially being in a position ranging from really bad and distressed and stalled up to comfortable and ultimately killing it really good. Now, people think about their progression to this point and think about it as a straight line, but it's not a straight line because of that compounding impact of time and money that we saw. So when people are looking to go down this path, it's understand that, if you're not on track to end up exactly where you want to be, the easiest time to take action to jump that line is right now. The more that time goes on, then you just need to stay on the line and follow the bouncing ball to make it happen. But if the more time goes on, then you look at the gap, and jumping what we call jumping the line becomes more and more painful, and making this sort of sacrifice can be impossible. So if I can leave you with this quote from Derek Sivers, and anyone that's been following on this series might have seen this one already, but it's saying, if information was the answer, we'd all be billionaires with perfect apps, which is totally true. We don't need more information or ideas. What we need is to take action, and focused knowledge is the key to doing that. So you guys have all taken the first step today. Well done. Like I say, well done doing it this time of year as well, with all of the competing priorities that are out there. But you need to take the ideas and turn them into results. Look, how we might be able to help you with that, and I've just put a link here in the chat box, but we do these 45-minute one-on-one money breakthrough sessions, basically helping you get on the front foot for 2021, getting your money questions answered, and if a property is what you want to achieve, then thinking about the key things that you can do to move the dial to get there. We're also donating all of the money that we raised for charity, and I am so close that I had a target of $20,000. We're currently at $19,440. So I basically got 4 more slots that are available. I would love for you to help me get involved and do that. I'm discounting them until the 31st of December. There's only a handful of places available, all for January, so you can hit the ground running in January and move forward, learn a bunch of stuff, and also do some good in the world at the same time. So I'm just going to jump into the Q&A. Anyone feel free to fire any questions that you guys have got in there. Good Tom has asked, do you have a calculation that would subtract the interest paid on the mortgage over 40 years from the final value of the property? Look, I don't, Good Tom, but I'm sure with a good spreadsheet, you could definitely do that. And yeah, it's a good pickup. I think you're referring back to the stuff that I went through right at the start, that it isn't a perfect science, because you are going to pay some money in interest. But if you think about, say, that $500,000 property and you borrowed at $500,000, you're paying $20,000, $25,000 in interest, say at 5%, like long-term interest rate. Over 40 years, that's $1 million in interest payments. But you see that the property value went up from 500,000 to three and a bit million. So there's a lot of room to cover those mortgage payments and still be well ahead. Nick has asked, there are some very cheap properties in places like Broken Hill, like $50,000, where people seem to keep wanting to live. Are these worth it? Look, Nick, I think that with those properties, they can generally in regional areas that there is a higher rental yield on those properties. So if you're looking at investing in property from an income perspective, then sort of those properties can be good. The thing is that you generally don't get a lot of growth on those properties because there's so much supply out there. You think of a place like Broken Hill that there's just endless land that people can build on. So people are not super likely to pay more for one property than another because of the fact that there's so much out there. Same question there. Great. Lily says, no deposit, being age 55, finding it hard to secure a loan. What options do I have? Well, Lily, I would say best bet is to speak to a good mortgage broker as a first step. I'm not a mortgage expert, so I don't know. There can be like low doc loans or unsecured loans, but I don't generally recommend those ones because of the fact that there can be, it's a bit of a minefield, and you can end up paying a heap of money there. So I would say good mortgage broker is your best bet, and they should be able to point you in the right direction. And question here, hey Ben, I was lucky to buy my parents' house for 120 grand a few years ago, and now I have 50K left to pay off. The house worth 650. Could you talk about some different things I could do now to be able to buy an investment property? Well, I think you could just borrow against the equity in that property and buy an investment property immediately. I would think. I suppose you could do a debt recycling strategy, build a share portfolio, create some tax deductions, and maybe use that to use a deposit for the property. But if you've got a lot of equity, like if the value of your property is high and the loan is low, then normally the banks are going to be pretty comfortable to lend you up to 80% of the value of your property. So that could be used to fund the deposit. You do still need to be able to service the loan though. Yeah. The recording will be emailed. Someone's saying, any useful resources for more info if we want to learn more? Look, I can do this. So I'm just going to post into the chat box. I'll just tidy this up a little bit. A handful of things that I've found are helpful. Most of them are created by us in full disclosure, but podcast, I've got a book that I released where I talk a lot about property. In fact, it's the biggest chapter of my book. And we've got a handful of other events coming up with General Assembly and Raiz. There are 3 more events that are coming up in January. So I put the link here. I'll just put it over here as well. But for anyone that's interested, check out on the General Assembly page. They're all really practical. I think we've got money mistakes coming up, money mindset, which is super important, and the third one I can't remember off the top of my head, but I'm sure it's going to be fantastic, in my totally unbiased opinion. Dev Jenny has asked, how to upsize property, sell current house first, then rent while looking, or put current house on the market and look for property at the same time? Yeah, look, I think that's one where you want to, there's no one right answer there, Dev Jenny. I think that you want, it can be risky if you're doing bridging loans and owning 2 properties, especially because the property market is a bit volatile at the moment. So I've had some clients looking to upsize recently, and they decided to sell their home first, lock in the cash, make sure they had the money, that they knew what money they had to work with, and then go shopping for their new home. Lower risk strategy in one way, although if the property market was to run really hard, then you do get caught out with that one. Although with COVID, I don't know, we are seeing some rises, but it's a bit of a mixed bag there. Brendan says, for investment property, do you prefer inner city apartment or outer suburb house and land? Look, my personal preference would be inner suburb apartment. You want to try and get as much land as possible, but I wouldn't compromise in the population growth of the area in order to do that. I'm going to just take one more question, and then I'm going to go. I'm going to have to wrap this up. We are going to send the recording around though. So any other questions, please hit me up. Pivot Wealth website, www.pivotwealth.com.au. And yeah, so Sachin said, mention a lot of data is available on the ABS website regarding future population growth in suburbs. However, you advise against looking too much into that information. Yes, what would you advise on why you elaborated that that's the case? Well, I just don't want you to get into analysis paralysis. And I saw someone on the chat put something about what are the traps that engineers fall into. And that's the thing, that you make all these spreadsheets, and then you're doing all this crunching, and it's like, what's this yield versus that yield, and which one's the best? And then you end up just overwhelmed, and no one knows what's going to be the best until after it's happened. So I think if you settle for something that's really good and take action, you're probably going to get better results than trying to find all this mythical best thing that never comes apart. So team, I hope you guys have found that helpful. A lot of great chat there as well, and great to see so many people pumped up on this. Would love you to get involved in these breakthrough sessions. Hit us up, it drops a line if there's anything else we can do to help, and have a great Christmas, everyone. I'll see you on the other side.